Welcome to The Explainer. You know, in business, the biggest threats, they're usually the ones you never see coming. So today, we're going to talk about how to get that foresight, how to spot risk before it spots you, using some really powerful lessons from the world of finance.
Right, so let's kick things off with a story you might think you know pretty well. It's a classic for sure, but it has a huge lesson about a kind of risk that loves to hide in plain sight.
Get this. Way back in 1975, it was engineers at Kodak who actually built a working digital camera. This wasn't some upstart competitor they needed to worry about. The revolution was literally starting inside their own building. But instead of seeing this incredible opportunity, you know what management saw? A threat. A threat to their super profitable film business.
And that brings us to the billion-dollar question, doesn't it? They were holding the future right there in their hands. They invented the very thing that would completely disrupt their entire world. So what on earth happened?
Well, the answer comes down to this really powerful and often overlooked idea: strategic risk. It's just like the slide says. It's the risk that your big plan, your whole strategy, just stops working. Kodak's entire strategy was built around selling film, and by trying to protect that old plan, they completely failed to create a new one for a future they themselves had invented. The whole Kodak story is just so wild because it proves that the big risks in business aren't always about a stock market crash or some accounting mistake. Nope, they're usually about these huge underlying forces that every single company has to deal with. So let's break them down. First up, the one that got Kodak: strategic risk. This is the big existential question for any business. Is our plan still working? You know, think of Blockbuster clinging to its video stores while Netflix was mailing out DVDs and then started streaming. It's the risk of your entire business model just becoming a dinosaur. All right, next we have compliance risk. This one's pretty straightforward. Are you following the rules? And this could be anything from data privacy laws like GDPR to environmental regulations. You mess up here, and you're not just looking at fines. You could destroy your company's reputation overnight. Then you've got operational risk. This is the danger that comes from the inside, when your own people, your processes, your systems just fail. Like an employee accidentally wires out 1 lakh rupees instead of 10,000. It's about the internal machinery just breaking down. And finally, we have financial risk. Now, this is the one that probably comes to mind for most of us, right? It's the risk that money just moves against you. For instance, say a company takes on a ton of debt and suddenly interest rates shoot up. Poof, all their profits could get eaten up just by those loan payments. Okay, so let's zoom in a little bit on that last one, financial risk, because it's not just one thing. It's actually more like a family of different risks, and it's really crucial to know the difference. Yeah, as you can see, financial risk is this big umbrella term. Let's look at a couple. Counterparty risk is super simple. What happens if the person on the other end of your deal just doesn't deliver? And then there's liquidity risk, which is so dangerous. That's when you go bankrupt, not because you're losing money, but because you literally run out of cash to pay this month's bills. It's how a lot of otherwise healthy companies go under. So, okay, if we can name these risks, the next big question has to be, can we measure them? I mean, how do you put a number on something as fuzzy as uncertainty? Well, this is where a really clever tool from the world of finance comes into play. It's called value at risk, or VAR for short. So value at risk, or VAR, is basically a way to make financial risk feel real and tangible. It's a statistical trick that tries to figure out the absolute most you might lose on investment, say over a single day, with a certain degree of confidence. And this is why it's so brilliant. VAR takes all this complicated, chaotic market stuff and just boils it down to the 2 simple questions you see right here. It turns risk from this vague, anxious feeling into a hard number you can actually use to make decisions. Okay, so let's do a really quick walkthrough of how this works. Don't worry about the math, just follow the logic here. So first, you start with how much your asset is worth, let's say 2 crore rupees in shares. Then you figure out its volatility, how much it tends to jump around each day. Maybe that's about 4 lakh rupees. The next couple of steps are just statistics. You decide how sure you want to be, let's say 99% confident, and you find the magic number that goes with that, in this case 2.33. And then the final step is where it all comes together. You multiply that daily volatility by the statistical number, and bam, you get this, 9.32 lakh rupees. And here's the incredibly powerful thing this number lets you say. Based on what we know, we are 99% sure that our portfolio will not lose more than this amount in one day. All of a sudden, that vague risk has a clear boundary. So we can identify risk and we can even measure it. But now for the most important part. What do you actually do about it? Because knowing is one thing, but doing is where the real work starts. And the point is, for every type of risk, there's a playbook. There are moves you can make. To handle counterparty risk, you do your homework on who you're dealing with. That's called due diligence. To lower your political risk in another country, maybe you try to source your materials there or you partner up with a local company. See, identifying the risk is just step one. Having a strategy is what really keeps you safe. At the end of the day, you can never completely get rid of risk. It's just part of the game if you're trying to do anything meaningful. But you don't have to be a victim. By learning to see these forces, measure them when you can, and have a clear plan to deal with them, you stop just hoping for the best and you start being prepared for the worst. It's the difference between being blindsided and being ready. So that leaves me with one final thought for you. What's one risk in your work or maybe even just in your life that could use a management plan, starting today?